I'm Bill Keep.
And I'm Nancy Lasher. Welcome to Profit, Power, and Policy. We do the research and explore how laws, regulations, businesses, and big money in politics have worked to the detriment of consumers and citizens. By the way, if you would like to watch as well as listen, we are now available on our YouTube video channel. Bill, today we are going to talk about the miserable state of health insurance in the U.S. In 2019, I tore my two left meniscuses and needed to have them surgically repaired. My orthopedic surgeon got insurance approval. I did all the pre-surgery PT, and off to the OR I went. Then I did the post-surgery PT. A couple of months later, I received a letter from the insurance company saying that I did not have permission to have two procedures on the same knee at the same time and that I owed almost $1,000 to the surgeon.
How'd that go over, Nancy?
Shock, words not acceptable for this podcast, confusion since the surgeon had approvals before operating. After I calmed down, I wrote an appeal letter to the insurance company. I said, "Are you saying you would pay twice for all of the PT, pre and post procedure, the use of the operating room, the anesthesiologist, and the surgeon? How does that control healthcare costs?"
And what happened to your appeal?
The insurance company actually wrote a letter apologizing, but think about it. How many people would have had the presence of mind to follow the insurance company appeal process and write that letter?
Unfortunately, Nancy, many people have had your experience, and many have had worse. Unraveling the rat's nest that we call healthcare insurance matters if we hope to find a fix. More than ever before, the healthcare insurance industry has everything to do with making profits and little to do with what most people consider to be the purpose of insurance. As a result, in the U.S., people face uneven access, high premiums or high deductibles, required prior authorizations, denials, and poor outcomes. Nancy, we spend twice per capita what peer countries pay for health care, and our outcomes rank among the lowest. We have more chronic illnesses, higher infant mortality, and a high rate of preventable deaths, and we die younger. What got us here? Where does all the money go?
Bill, we will spend the entire podcast answering those questions. Let's start with the mixed signals we send young parents. On the one hand, we often talk about the importance of raising a family, but once you had a baby, you face a confusing mix of choices in providing health care coverage. Unlike peer countries who have seen the wisdom and financial benefit of having required health insurance that ensures coverage for all and regulated cost containment, the U.S. emphasizes privatization and individual choice. In the U.S., this often means I'm not paying for X or Y or Z's healthcare. So we have a system of thousands of different plans. Everyone pays something different, and coverage varies greatly. If you are fortunate enough to have health insurance, it is not universally accepted. And Bill, why hasn't competition among private insurance companies driven down costs?
Good question. As healthcare is not provided by the government, it is not a public good like national parks, where everyone can enjoy the same benefits at the same cost. We will talk about some Medicare and Medicaid coverage, but about two-thirds of the U.S. population has some form of private insurance. And private health insurance is dominated by a small number of companies, all of whom have a vested interest in extracting profits as opposed to driving down prices. Nancy, the current system does not work for many people. Help us out and describe the basic notion of health insurance coverage.
For reasons ranging from internal biological differences and aging to external factors like accidents and injuries, people will need health care. Some more than others, some more frequently than others, and some more chronically than others. As the risk of incurring a healthcare cost can be unpredictable, pooling risk reduces the potential financial loss of any one member of the pool. Under the pooled model, an event that possibly creates a huge financial burden becomes bearable as the pool absorbs much of the financial impact. Bill, have you ever had your property landscaped? A certain number of the shrubs will not make it through the first 2 years. In a new development, suppose 100 people each paid $2,000 for landscaping, mostly shrubs. Like humans, shrubs can have biological weaknesses and or fail due to external conditions like rough weather. Further, suppose that historical data shows that 2 out of every 100 homeowners will experience a complete loss and need new plantings within the first 2 years. In which case, two homeowners will have no shrubs and will be out $2,000. Recognizing the risk, if each homeowner purchases a 2-year insurance policy for $80 total, they create an $8,000 pool that could pay a $2,000 benefit to up to 3 homeowners that lost all of their shrubs within the first 2 years and cover the administrative costs.
Human health conditions are more complex and more varied, but your example, Nancy, illustrates the core concept of a risk pool. The insurance company's job is to calculate the risk of an event, such as the shrubs dying within 2 years, and set an insurance premium sufficient to cover the payout benefit and administrative costs. Early insurance companies did this. They were not for profit, unlike today, but rather insurance pools owned by those who paid the premiums, typically called members. Each year, these mutual associations would calculate the premiums paid in, the amount paid out in benefits, administrative costs, and adjustments for the coming year. Excess funds would be returned to members, or, if needed, premiums increased. This early model was used for life insurance, fire insurance, back when a fire could burn down a whole neighborhood of wooden structures, and health insurance.
But we're a long way from that now, except for the burning Brooklyn Bridge on July 4th. Insurance premiums represent a regular cash flow, and with America's population growing, investors saw an opportunity. As with other types of corporations, a publicly traded insurance company could grow with an injection of funds from investors. Soon, for profit insurance companies grew. The change from nonprofit mutual associations to for profit insurance companies can't be overstated. There still are a few mutual associations around, but for the most part, for profit insurance now dominates the industry. The former serves investors while the latter serves only its members. Because insurance companies invest money from premiums, they also, in effect, are financial institutions that offer a service insurance.
Like publicly traded banks, publicly traded insurance companies rely on money from customers to fund services and to generate profits for investors. These insurance companies make money in two ways. They earn a net profit if total premiums paid are greater than total payouts and administrative expenses, and they make a return on investment in a wide range of stocks, bonds, real estate, and private equity called float investing. Solid underwriting, which means accurately evaluating risk and charging appropriate premiums, plus carefully watching administrative expenses, can provide profits. But in any given year, more than 50% of profits comes from float investing.
Let me make sure I heard you correctly. 50% of profits that health insurers make come from float investing. So we pay our premiums, we fight denials of coverage, and the insurers are making money that doesn't go toward our health care?
Yeah, mostly correct. Let's say an insurance company had a bad year with a greater payout than expected by underwriters. In that case, the gains from float investing, again, which is investing the premium money paid in, would be used to offset the unexpected loss from premiums. But with reasonably good underwriting, that should not happen, and some profits will come from the insurance operations, but the bulk of profits will come from float investing.
Okay, I'll make an allowance for a once in a century pandemic since we lived through COVID-19. But to call this health insurance is pushing the definition of insurance. This sounds like almost pure financial services, playing with the money coming from premiums.
Agreed. Executives in the not for profit model were incentivized to have solid underwriting and controlled administrative costs. Any excess went back to the members. Executives in the for profit model are incentivized to keep their investors happy, protect and increase the share price, and protect their own pay and bonuses. Critics have pointed out that payouts can detract from that, which is why required prior authorization and denials can make a difference. Pay less out, retain more for profit. Customers are not the owners. They are the source of cash used to please investors.
Writing as a source of profit depends a great deal on the accuracy of companies' actuaries in determining risk, the chances of someone having a condition or health problem, the composition of the pool of people covered, and the premiums paid. Changing the pool can change the risk. Over time, science has identified underlying causes of numerous diseases, and science has also linked some health conditions to certain lifestyle behaviors, such as smoking. This does not mean a direct relationship that if you have precondition X, then you might or might not get health problem Y. Mostly, it's a matter of probabilities, such as the increased probability of having breast cancer. And this is enough to change your risk profile.
Yep. Insurance company use this data to calculate premiums such that two people of the same age, gender, and general health may pay two different premium amounts because one has a precondition, the other does not. Now let's go back to your purchasing shrubs example. In that example, all shrubs appear to be the same, and thus the risk of something happening to the shrubs was the same. But if some shrubs had preconditions, or some owners don't water according to instructions, those shrubs have a riskier profile. By slicing and dicing the data into multiple pools, the insurance company will set premiums reflecting the risk of each pool, protecting its profits. I think many people are comfortable with the idea that those who choose to engage in riskier behavior like smoking should pay higher premiums. But what about the people who, through no fault of their own, have preconditions that increase their risk?
What we would call SOL, shit out of luck. The closer and closer science gets to profiling the risk of individuals, the more fine tuned the underwriting and the more insurance companies can protect their profits by adjusting premiums accordingly. Now, someone might say, and I am sure many people have said, I don't want to be in an insurance pool with people who have an increased probability of a health problem relative to me. I want to only be in an insurance pool with healthy people like me, so I pay lower premiums. Taken to the extreme, that argument means those people who can be identified as having a higher probability of having a health problem will pay the most, even when it is no fault of their own. Of course, higher premiums increase the likelihood that a person will forego insurance. Under our system, the more the insurance companies slice and dice the insurance pools, the greater the chance that those needing the coverage the most will find premiums unaffordable.
And Nancy, that gets us to the final issue before we talk about how insurance companies protect their profits. Most workers in the U.S. acquire health insurance through their employer. During World War II, there were wage controls to prevent inflation. To attract employees in a tight market, employers started offering health insurance. These health insurance plans had the added benefit of being tax deductible to the employer and non taxable to the employee. This system stayed with us after the war ended, but it doesn't work for everyone. Some people have a difficult time finding any insurance pool to be part of. Small business owners, gig workers, and independent contractors do not have employer provided insurance. Not part of a big pool of employees means searching for insurance based more on their individual situation.
Let's not forget to mention the impact of higher healthcare costs. Increasing healthcare costs pushed up premiums. Over the last 25 years, employees have paid an increased percent of the health insurance premiums as employers tried to protect their own expenses and profits against the ever increasing expense of health insurance. So, in sum, we have insurance companies fragmenting risk pools with premiums set to protect their profits. We have people with preconditions finding health insurance less affordable. We have small business owners and independent workers finding it difficult to get into affordable risk pools. And we have employees of medium size and larger companies picking up more of the health insurance premium. Bill, wasn't the Affordable Care Act supposed to fix this?
Yes, actually, there have been several attempts to make health insurance more available and affordable. Let's talk a little history. In July 1966, Medicare became available to everyone over age 65. This provided hospital insurance to all senior citizens. Before that, at least half of all senior citizens had no health insurance and either paid for needed care out of pocket or went without care. Along with Social Security, this was a major step in addressing old age poverty. That said, Medicare was not universal health insurance, not by a long shot, not even for senior citizens.
There are two options for those eligible for Medicare: traditional Medicare and Medicare Advantage plans. Traditional Medicare covers hospitalization, preventative care such as vaccines, tests for diagnosis, physical therapy, doctor visits, and short term rehabilitation. That's parts A and B. Part D covers prescription drugs, but this coverage is not free. Someone who has paid into Medicare for at least 10 years still has a deductible for Part A, pays a premium with an annual deductible for Part B, and has a premium and likely copay for Part D. Traditional Medicare doesn't cover vision or dental care. Bill, as I say, the devil is in the details, and I have skipped many. It is enough to say that people struggle to understand this complex system.
The private alternative is Medicare Advantage. But Nancy, better watch out for those marketers. There is something in the word advantage that should make people a little cautious. The private insurance Advantage plans replace Medicare and receive money from Medicare equivalent to what would have been paid had the person stayed in Medicare. The amount is risk adjusted. Then the private insurance company can also add coverage like for eyes and ears, etc. Private insurance companies are incentivized to sign up seniors under Medicare Advantage and incentivized to deny coverage, which is what we will get to.
At first look, Medicare has a higher denial of coverage percent than Medicare Advantage, but as they say, looks can be deceiving. Medicare does not require pre authorization for most covered conditions. Some selected services do, and requests for these services get denied at a higher rate. Alternatively, the private insurance Advantage plans and other employer based private plans require pre authorization for a large percent of covered items. In short, private health insurance companies have a large pool of conditions, coverage for which can be denied, while Medicare does not.
Yep. Each year, most people eligible for Medicare have to make choices. Which plan? Which drug plan? Does this plan cover my medications? How can I predict which medications I will need this coming year? Should I choose Medicare Advantage? We spend a lot of time in the US when it comes to choosing health insurance, playing darts, or at least that's what it feels like when we need to choose this coverage. For example, someone I know had a specialized medication that would have cost $1,000 per month in addition to the normal premium under a Medicare Advantage plan.
Despite Medicare for those 65 and older and those who get health insurance through employment, and another government plan, Medicaid, for low income households and the disabled, there are still many people in our country who don't have health insurance coverage, approximately 8% of the population. Of those without insurance, 60% cite the high cost. When Bill Clinton was president, he charged his wife Hillary with the task of coming up with a plan to get health insurance to all Americans. The Clinton plan sought to provide all Americans with coverage by requiring employers to offer health care insurance and pay 80% of the cost, require everyone to be enrolled in a plan with each plan covering a standardized package of care, and manage competition within regional alliances to negotiate better rates. The lobbyists, big pharma, big insurance, and conservative groups went into action to defeat the bill. This was 1993.
Then came Barack Obama's Affordable Care Act, signed into law in 2010. Besides making insurance more affordable and more accessible, the law changed some key rules. Insurance companies couldn't refuse to insure you just because you had a pre existing condition. So if you had cancer, you are now still insurable. This flies in the face of underwriting that created different risk pools and higher premiums. People with preconditions were now part of a larger pool. In addition, it removed any annual or lifetime cap on what insurance companies would have to pay to cover you. Coverage included preventive services such as flu shots, vaccines, mammograms, and maternity care. Finally, young people can stay with their parents' plan until age 26.
The ACA set up marketplaces, also known as exchanges, for plans for people who need to buy coverage. Initially, this worked well, and more people joined the rolls of those with health insurance. The American Rescue Plan Act and Inflation Reduction Act, which both came from the Biden administration, most likely drove ACA marketplace enrollment to a record high in 2025, 25.2 million people. Each state could choose how best to implement the ACA and whether or not to expand Medicaid. That led to a patchwork of availability and coverage from state to state. Most recently, Congress did not renew the subsidies ACA enrollees were receiving, and ACA enrollments have already dropped off by almost 4 million people due to the higher costs, and the projections for 2027 are bleak. Many ACA insurers are seeking rate increases for next year as well. As more people leave ACA plans, the pool left to insure is sicker, leading to higher costs for the insurer. Thus, rates will jump again.
And there's one more piece to the insurance puzzle: prescription drugs. Again, we have a complicated system in which what you pay depends on whether you have insurance, and if you do, what plan. As with many things, there is a so-called middleman.
Hey, Bill, why don't we call it a middle person or a middle woman?
Nice try, Nancy, but there isn't much funny about our health insurance system.
You're right. Okay. This intermediary is called the Pharmacy Benefit Manager, or PBM. PBMs are supposed to save us money, but that hasn't turned out to be the case. Pharmacy benefit managers are owned by major healthcare systems. For example, CVS Caremark, or CVS, Express Scripts, which is Cigna, and Optum Rx, United Health Group. And there's tremendous incentive to keep business in-house. These three PBMs dominate 80% of all prescription claims in the U.S. By the way, Express Script owns the specialty pharmacy Accredo, and all three have sizable shares of the Medicare Part D prescription claims market.
Well, I'm not feeling the competition, Nancy.
I'm with you on that, Bill.
Here's the problem. While claiming to contain costs, pharmacy benefit managers actually are making big dollars for the companies that run them. They're often charging large markups on generic versions of drugs for diseases such as cancer and multiple sclerosis. They do this by purchasing the medications inexpensively from manufacturers, marking up the price, and requiring insured patients to obtain the drugs through a PBM's in-house pharmacy. The bill then goes to the insurance company at an inflated price. Meanwhile, patients have to pay higher deductibles or copays.
Say a standard available drug that has long been on the market and is available in generic form doesn't work for you. There is a brand alternative, but it is protected by patent and expensive. Your doctor has to appeal the refusal you're going to get from your prescription drug plan insurance company. In my case, my doctor had to tell the pharmacy insurance company that the available eczema treatments no longer worked for me. Twice. That's two appeals. I'm fortunate that the doctor was willing to do that. And the medication, which retailed from anywhere from $900 to over $1,000 a tube, ultimately cost me $35. When my daughter was placed on the same medication, she paid $6 on her plan. Please explain the logic to me.
Yeah, I would if I could. I'm glad that you and your daughter both received your medication. It serves as just one more example of a truly dysfunctional system. If patients have to struggle to get coverage or medicines at a fair price, the health insurance industry profits. From 2010 to 2024, major insurance companies were on a tear. They profited from all aspects of healthcare. The insurance pool grew with ACA, large numbers of baby boomers turned to Medicare Advantage, PBMs offered new profit flows, and some insurance companies became vertically integrated as they acquired clinics, outpatient surgery centers, and physician practices. Consequently, the insurance companies grew and the industry became more concentrated.
Before we close out, we should share some numbers. On average, the U.S. spent $14,775 per person each year on medical care in 2024. Switzerland spent $9,963, Germany spent $9,365, and the numbers decrease from there. Roughly 18% of our gross domestic product goes toward healthcare spending. The average life expectancy in the U.S. is 79 years. That's 3.7 years shorter than comparable countries. The Peterson Center at KFF cites reasons such as barriers to accessing healthcare in the U.S., including socioeconomic barriers. What have we learned so far? We have a healthcare system in which people pay different prices depending on whether they have insurance and what insurance they have. Price often isn't connected to the cost of producing the product in the case of prescription medicine. There are layers of people in between patients and providers, reviewing and sometimes denying care.
And Nancy, we have learned that for profit health insurance has stockholders to please, highly paid executives, and a great deal of latitude over what needs pre authorization and what will be denied. To the average citizen, decisions over coverage happens without rhyme or reason. But we know these companies do have reasons. They have to do with profiting from the process of offering health care coverage in a manner that is neither consistent nor transparent, and they like it that way.
Bill, these companies spend tremendous amounts of money and effort to protect their profitable ways. Looking at three of the largest health insurance providers, the numbers are rather shocking. Over a 6-year period, from 2019 through 2024, United Health Group, CVS Health Aetna, and Cigna spent over $152 million on lobbying. That amounts to over $25 million annually to make sure their favorite members of Congress take care of their interests. These three also paid out in campaign contributions nearly $30 million, or about $5 million per year during that same time period. Bill, we know too well that in Washington, D.C., money talks and bullshit walks.
Indeed, Nancy, indeed it does. Consequently, the United States pays too much for health care for too little actual health care, and we see the results. Unfortunately, the average U.S. citizen has been sold a story that our nation, unlike every other, knows the best way to take care of its people, despite the evidence to the contrary. Single-payer systems are labeled socialist, despite having better outcomes at lower costs.
Hope our podcast helps you think about these issues. Who has power, how they exercise that power, and how it impacts you and your community. When people talk about critical thinking, they mean a healthy skepticism when examining information. If you enjoy our podcast, whether on YouTube or the audio version on popular podcast platforms, please like and subscribe and share it with others. We welcome your comments, questions, and topic suggestions. Send your comments or questions to our email, asrb1776@gmail.com. That's asrb1776@gmail.com. And check us out on Substack.